We're here to talk about Silicon Valley real estate market conditions for the week of September 20th. This is a quick recap of what we're going to be going over. There are links in the description below to each segment. In respect to everyone's time, I'm going to move right on and come back to this. Here is days on market, and this is an important indicator because it shows how long it's taking to sell properties. Nobody's in control of that. How quickly does the buyer write up the offer? How quickly does the seller respond? It's out of any one person's control. What we have is a distribution of the past year. Basically, from a year ago to 3 months ago, I jump roughly a month at a time. I don't do anything on a monthly basis. It's either 4 or 5 weeks. And then at 13 weeks, which is 3 months ago, I jump to 1 week at a time. The red dotted line is the hottest marketplace, and that's consistent throughout my slides. The blue dotted line is the coolest market we've ever been. The blue dotted line is where we were a year ago. We were in a hotter marketplace than we are right now, which is the purple dash dotted line. Starting off a year ago, so we're starting on the blue line, and we'll just march through, and you can see the change from week to week. And so there's the slowest week. And now you had the huge run up in the spring, which is fairly typical. And now you're starting to do this summer slowdown. And now we're actually starting to get into the fall plateau before we get into the fall plummet. Here's sort of the fall plateau where all these solid lines are very close together. They're solid not because they're close together, they're solid there because of the most recent 6 weeks. And now we're back to today's line. So there was a slight improvement from a couple weeks ago, but in general, we're at a plateau before I'd expect the marketing time to tick up, just like when we started at the blue line at the beginning of this little tiny movie of slides, it started cooling down. I'd expect this purple line in general to move this way. Now, do keep in mind that when we started this, we were jumping 4 and 5 weeks at a time. So don't expect that much jump from 1 week to another. Now we're moving on and looking at the ask price reductions. Why this is important is sellers study the market with their agent before putting their house on the marketplace. And when there's a lot of price reductions, that means sellers' reading of the marketplace, the agent's reading of the marketplace, their expectations were higher than the market reality. At some times of the year, that's where we're at. Other times of the year, their expectations were lower. And that's typically in a period of time early in the year when there's rapid appreciation. But the concept's the same. The blue dashed dotted line is at the bottom now because a lot of price reductions are a cool marketplace. And a hot marketplace is right up on the top here where nobody does any price reductions. And that's actual data. I saw Valentine's Day of 2022, where basically no sellers were taking price reductions. And when I say no, I only go down to 2.5%, because once you go below that, you get errors with the data input and that kind of stuff. Now, I'll also point out on this slide, I only go up to 17.5%. I'm ignoring 82.5% of the marketplace. And that's because of that research I was talking about. Most of the sellers come on the market very close to the asking price, and you can see that they don't, more than 17.5% rarely will be taking off doing a price reduction. Now you can see there's these 3 faint dotted lines here where more than 17% were taking price reductions, but that's pretty rare. So again, stepping through, starting on the blue dotted dashed line, you can see we cooled down, and then we turned around and went up, and there's the spring run up. We're about ready to hit, there's the peak. Now we're cooling down a little bit, and in a couple more slides, we'll be right about now, there's not much change, and you can see there's bounce. So that's sort of the summer plateau that we're in, and we're not yet to the fall drop off. So you can see there's some movement, but it's in both directions, up and down. There was a big improvement. Now it decreased. Now we improved this week from last week. And that's why I call it a plateau. There's movement in each direction. Moving on and looking at the overbidding. This is what buyers do. This is a measure of how competitive the marketplace is. And unlike the previous 2 sets of slides, the purple and the blue line are fairly close together. The purple line is slightly below the blue line, but much closer together in this particular measure of the marketplace. But the concept's the same each week. Hot marketplace, cold marketplace. It moves up and down along this sort of blue diagonal line in a rough approximation. And there we start, and now you're starting to hit the fall off. There's sort of bottom of the marketplace. Now you're hitting the spring run up. You can see how rapidly it jumps up. Now you're sort of going to be coming in the spring fall down. And then pretty soon we're going to be hitting the summer plateau. And I would say with that week there, we're sort of at the summer plateau. You see how there's not much movement from week to week. So again, in all three measurements, this one's the least difference, but the market's cooler now than it was a year ago. Now we move on to my micro market maps. And what's really noteworthy, in my opinion, here is just a few weeks ago, this particular map would have been pretty red, showing a lack of inventory. Now the map is noteworthy in the fact that there's the complete absence of color. And if you look at the actual numbers over here, they're right around 100%. And I consider no color on 12.5% on each side of 100%. But we're well within that, 97%, 96%, 92%, 91%, 95%, 98%. The one exception is the moderately affordable areas in Santa Clara County, which are Campbell, Cambrian, Santa Clara, and Willow Glen. And you can see at 76%, that is a shortage of inventory. So we've gone from a shortage of inventory to about the normal inventory you'd expect. The other thing that's noteworthy is our maximum inventory appears not to have been yet reached this year. This week, we have more inventory than we've had in any past week this year, and it's unusual, but the peak inventory does occur as late as Halloween, but more often than not, it's typically in the June through August timeframe. I usually pick July 19th as sort of the typical time frame. Yes, it moves on both sides of that, but we are getting to be one of the later peak seasons, and it's been increasing fairly significantly in the last 2 weeks, which I find interesting. Here is the offers, and this story has not changed. We still have a lack of inventory, as you can see by either the blue in the index or blue on the map. The darker the blue, the more it favors the buyer, so that would be a lack of offers. And at the very bottom, I have my index. 11 through 17 are micro markets in Santa Clara County. 21 through 26 are 6 micro markets in San Mateo County, and 31 through 37 are 7 micro market areas in Alameda County. And those are the same for all my slides. I've numbered them to try to make it easier for you to track. Here is days of unsold inventory. This is a measure between the supply and demand of the marketplace. And this is comparing, as the previous two slides, the current DUI to the 10-year median. So whether you have a higher number in the case of the expensive areas in San Mateo County at 140%, a high number is a slower marketplace because that's a larger number of days to sell your inventory. And most of the marketplace is pretty close to 100%, but on that close to 100%, noting the most of them, like Alameda County, San Mateo County, and even half the areas in Santa Clara County are above 100%. So we are actually having a slower marketplace right now than we have had at this time of the year for the past 10 years. Now, until this week, we've actually been having a faster paced marketplace. And, it's been a fairly rapid change, but it hasn't been just 1 week. It's been a movement in a cooling off of the marketplace, but it's not a cliff, but it's more rapidly than I would expect. Here's your days on unsold inventory compared to now. It's just an absolute measure. And so despite the market being cooler than normal, we're still a hot marketplace, because if you look at these, most of our micro market areas would sell out their inventory in under a month. And I consider anything less than 6 weeks to be a fast-paced marketplace. And this is a theoretical number, but it's still, it's a reasonable measure. It's the turnover rate of the marketplace. How long would it take to sell your existing inventory at the existing rate of sales? And we'd sell out everything in about 30 days. But of course, the reason it's theoretical is you always have new inventory coming on the marketplace. It may be in different quantities, but there's always some new inventory. Now we're looking at the first metric that is real easy to understand, real simplistic. Simply, how long does it take 3/4 of the sellers to sell their properties? And you're red or pink in color if 3/4 of your sellers are selling in under 3 weeks. So that means 3 out of 4 sellers, 6 out of 8 sellers are selling their property in 3 weeks or less. So there's 2 areas where we're at 58 days, and that would be the San Mateo County coast and Oakland area. So right here by the Oakland airport, you can see a tiny little shade of blue. And then over here on the coast, you can see a little shade of blue. And it is hard to see the different colors with the background, and I apologize, I don't have any real control over what map. The advantage of the color is you can see where the mountains and the hills are. Moving on to ask price reductions. This is simply if sellers are taking more than 1% price reduction, they're blue in color. If they're taking less than 1% of a price reduction from 1/4 to 1, they're neutral in color. And if they're raising their price or they're taking less than 1/4% price reduction, they're pink in color. And you can see the only pink we have is the affordable areas or the moderately affordable areas in Santa Clara County, which are Milpitas, North Valley, Blossom Valley, and Santa Teresa. I have 2 moderate areas. That's the low moderate, and the Campbell, Cambrian, Santa Clara, Willow Glen is the high moderate that I mentioned earlier. But you can see that a good part of the valley is white in color, which means the sellers are taking reasonable price adjustments. There are a few areas where they're blue. I think it's 4 areas where, well, actually it's more than 4 when you start looking over here. There's 2, 5, you got 3 right here, 8, 9. 9 out of my 20 areas are a shade of blue. And if I looked at it more carefully, it'd even probably be a higher number. But I look at the map, yes, I can see that the affordable areas, East, Central, and South San Jose, is a slight shade of blue. Morgan Hill, Los Gatos, the expensive areas in San Mateo County, the San Mateo County coast. And I really don't detect it up here in Oakland, but it's apparently there. Moving on to the frequency of price reductions. So this is how common are sellers making price reductions. And when it's less than 17%, which is basically 1 in 6 sellers taking a price reduction, I consider that to be a fairly aggressive marketplace. 1 in 5 to 1 in 3, that's a fairly cool marketplace. Doesn't take much to get into a cool marketplace. And you can see there are a few areas that are a cool marketplace scattered throughout, because you have 25%, 25%, 31%, 23%, 23 and 25%. All above 20% of the sellers. So anytime you have more than 1 in 5 of the sellers doing a price adjustment, it's a cool marketplace. And I've never seen where we've had 20% of the sellers doing a price increase. Yes, I've seen some sellers do price increases, but it's typically where they've either made a typographical error that I try to correct out of the data, or they've tried the marketplace to stimulate multiple offers and that failed, and then they raised the price to their expectation level. Here's the magnitude of overbidding. So this is how much buyers are overbidding. This is going to be a lagging indicator for a couple reasons. 1, it takes a while for the buyers to realize the market has slowed down. 2, it takes 3 to 6 weeks for escrows to close. And in a slowing marketplace, escrows tend to be longer, and so the time lag becomes longer. When you're in the peak of the marketplace, the time lag tends to be shorter because the buyers are being aggressive in their offers, and shorten that 6 weeks down to 3 weeks, and therefore shorten the duration of the time lag. From looking at the magnitude of the average overbid of the buyer, you would say we are in a hot marketplace. And the magnitudes are not huge percentages, but when your average overbid is 4, 5, 9%, and especially when you take consideration the prices that we have in the Bay Area, that becomes significant. The only area that I'm seeing negative is the coast, where when the offers come in the door, the buyer's taking a 2% price reduction instead of an increase. Here's the frequency of overbidding. So this is how common is overbidding. And you can see it's still pretty common, all above 50%. And I would say it's right around 2/3, because you got a lot right here in the low 70s. You got some right at 65. You got a bunch right down here on both sides of 2/3. But then you also have some areas where you're flirting with the 50%, 45% in Pleasanton, 51% in Dublin. That means half the sellers are getting less than their asking price. San Mateo County coast, only 1 in 3 sellers are getting more than their asking price. And in the expensive areas, it's every other seller is getting more. Here is the appreciation. For this, I was trying to find a whole year of flat prices. The best I could find is 9 months. That 9 months happened to be the last 9 months of 2015, and this is the rate of appreciation since that time frame. Here, blue is the least amount of appreciation and red is the most. And what's really telling is the more outlying areas that used to be undesirable because of commutes are seeing the appreciation in the recent years, which gives them the overall best appreciation because of compounding. And the areas that are close to the work centers are no longer getting that huge premium for short commute distances, and so they're having the least amount of appreciation. Here's the sold price, and instead of following the middle number, which is the median as most folks do, I add in the 10 percentile and the 90 percentile. So this gives you a price range in any area. And 80% of the homes in South County will be between 926,000 and 2,050,000. And the middle number is 1,220,000. So there's only $300,000 range between the bottom of the marketplace and the middle. And there's an $800,000 range between the middle and the top of the marketplace. So that gives you an idea of how compressed it is, which is why if you're able to stretch your budget ever so slightly by going from a 30-year fix to an adjustable, or having relationship banking by moving some leftover money into that bank that you borrow from, and a little bit more money buys you a lot more house if you're below the median. If you're above the median, the delta isn't as much. But between the bottom and the middle is always going to be more condensed than between the middle and the top. Here's a summary of what we went over. We start off in Santa Clara County. I sort of segmented the county. So the top section is Santa Clara County. The middle section is San Mateo County, and the bottom section is Alameda County. The first two really don't tell you what the market's doing. The light shade of highlight at the top here gives you some indication of what the market is. The darker shade in the middle two here are the ones that are, in my opinion, the most indicative of the marketplaces. Nobody really has direct control over those. And then the orange are the lagging indicators. And again, dark orange is more important than the frequency. The magnitude decreases sooner than the frequency of overbidding. And then the appreciation rate and the price really doesn't tell you market conditions. I added in the monthly payment over here. That assumes a 30-year fixed mortgage, and interest rates dropped fairly significantly last week. I think they went from 6.35 on the national average to 6.2. So that's an 8% price reduction on the interest rate. Here now is a quick summary of some of the slides. This is your inventory. What you have going on here is the gray line is the normal, and I define the normal as the 10-year median. The purple is the actual data. The red would be a hot marketplace, and the blue would be a cold marketplace. And the blue and the red do flip from top to bottom, depending on the metric. In this case, a lot of inventory would be a cool marketplace. A hot lack of inventory would be a hot marketplace. You can see we've had over the summer, we had a fairly significant lack of inventory, as you can see by the spread vertically here between the gray line and the purple line. But now that we're back over here, which is the current week, we're at 90%, and 14 weeks ago we were at 90%. I picked 14 weeks because that's a quarter and put it on the sandwich. So this is September 14th. So this is some date very close to June 14th. It should be 98 days ago. And then offers accepted, which is sort of the converse of inventory. So this is the demand. So now the purple has been falling right on top of the cool from 14 weeks ago to about 7 weeks ago. And then starting about 7 weeks ago, look at, we're below. So we have lower demand than you'd expect, but on a percentage from the gray line, because the gray line's coming down, you're also unchanged. You're at 80%, 79% of normal. Here you're at 78%, so that's unchanged. But look at the number of offers. They went from 2240 down to 1990. So we've had a drop of 250, roughly 1/8 of the marketplace. So that would be we've had about a 12% drop in the number of offers, but that's what the percent being unchanged is telling you. That's completely normal. Days of unsold inventory, this is the balance between the sellers and the buyers, the sellers being inventory, buyers being demand. Now here you went from 116% of the DUI to 107%. So you've improved, and you can see that a little bit. The vertical separation here is bigger than the vertical separation here. Meanwhile, even though the market's improved compared to where it normally goes, the overall speed of the market went from 38 days to 41. So you've had almost 42. So you've basically had a slowdown of 3.5 days. It's taking 3.5 days longer, which is basically 10% longer to sell your house. At the same time, compared to normal, the market's improved because this is a lower percent. So what's that saying? It's saying the market slows down at this time of the year, but this year the market has slowed down less than it normally does. So the market has actually improved compared to that 10-year median. Now we're moving on to days on the marketplace. This is the time that it takes 75% of the sellers to sell. Where it was 14 days, it's jumped to 26 days. So it's almost doubled their time frame. It's gone from 82% of normal, so less than normal, to 107% of normal. So it's gone up 25%. That's pretty significant. So the marketing time has gone up, and you can see that. You were real close to the red line here, way below the gray line. Now you're slightly above the gray line and way above the red line. So you've had a significant increase in marketing time more rapidly than normal. It's interesting that two things that sort of measure the speed of the marketplace, one up here has had a slight improvement, the days of unsold inventory, but yet marketing time has had a significant decrease. How do I explain that? Well, you could have had an increase in the number of sales causing the DUI to be lower and not really impact speed, especially if this increase in sales has happened after sellers have done price reductions. And speaking of price reductions, we were going from a typical 0.6% price reduction to 1.4%. So you're almost doubling the amount of your price reductions, but compared to normal, you were at 8% above the normal, and now you're 25% above normal. So again, you're taking larger price reductions, and you can see that your separation from the gray line right here is very close, and it's been gradually getting bigger, and it's not bad now, but it's clearly on the blue side, the cool side of that gray line, and there's clearly some vertical separation. Meanwhile, looking at overbidding, overbidding is 8.8% above the seller's ask price back here, which is 2% more than normal. And now we're at 5.6%, which is only 0.7% above normal. You can see the vertical separation was large here, and it's much smaller in the current day. So the right-hand side is current, the left-hand side is 14 weeks ago. Now we're looking this over back to the last 10 years to January 1st of 2014. Up until January 1st, 2023, I have what I call my condensed scale. Then 2023 is blown out to roughly double the size. And that's so you can start seeing the weekly movements that we have. And then the current year is showing in the more expanded scale. You can see that inventory in the purple has gone up significantly, not this last week so much. It went up a little bit, but the week before we had a big increase, and that was the week after the holiday, which was to be expected. Your offers also increased, which is why the DUI could improve and things like that while marketing time went up, because these properties had an extra week to sell since we had a low number of offers the week before, and the DUI has in fact gone down. So the increase in the number of offers this week is much more significant, but there's basically almost a week delay because it's this huge increase in inventory here, new fresh inventory coming on the marketplace that contributed significantly to this increase in the number of offers. This week, we only had a very small increase, so this increase in number of offers is going to be a lot smaller and could actually be in the negative direction. Here's your inventory compared to normal. So here, the next series of slides are all going to be the same. The gray is the normal based on the 10-year median. So that's what you'd expect the market to be doing. And yes, you have this little valley here and you expect up, but you can see that basically back here is the peak in the marketplace. And that's why I sort of say the peak in the marketplace is typically June 19th. Yes, we have had peaks as late as October, and this may be it right here back in 2018. you're well after you're slightly into fourth quarter, so that would begin sometime after October 1st. So we're not there yet, but with that rate of increase here, I don't know when we're going to turn over and roll down and start this fall cliff. You can see how the inventory normally falls off a cliff, and we're not there yet. We're sort of at a flat plateau time frame through here, and we're at the flat plateau, but right now we're at the highest level of that flat plateau. Here is the comparison, so you can see that we've gone from a shortage of inventory to growing up to in the range where I call it normal inventory. We're still below 100%, but we're starting to get in the range where I'd call it a normal marketplace. Here's the number of offers accepted, and here you can see it's very clear we have a shortage, because you expect to be up here at the gray line. The least you expect is the blue line, but we're significantly below the blue line, and you can see we have spent a fair amount of time below that blue line. If that's our new norm, in another couple of years, my 10-year median will start reflecting this new level and will move down. And the 10-year median is a moving number, and the 10 years used 2014 through 2023 that I used for that 10-year median next year will drop off 2014 and be showing 2024 as the expanded year, and 2025 will be the partial year. Here's the offers compared to normal, and you can see that we have a shortage of offers, which is why we're down in the blue section here. But you can see that increase of the current week. We're now at 80% of the offers that you would expect at this time of the year. Days unsold inventory, you can see we're above the gray line, not approaching the blue, because approaching the blue would be up here, but on the blue side. So we have a cooler marketplace than normal. Normal would be down here somewhere around 44 days, and we're up here probably somewhere around 46.5 days of unsold inventory. Here's compared to typical. So what you do is on this slide, you take this gray line and stretch that gray line out. This is that curvy gray line straightened out, and now you plot the purple line, the current data on that. You can see that inventory now is somewhere around 112% of where you'd normally expect it to be, 12% more. That's a 12% slower marketplace than normal. Here's looking at the easy to understand time on marketplace for the 75th percent seller. You can see that we're above the gray line. We're not very close to the blue line, so you're having a longer marketing time than normal, but you're still selling 3/4 of the marketplace out in 26 days. Here you can see you're increasing and you're getting closer to the blue section. You're still in what I would call a normal marketplace. Here's ask price reductions. So this is what sellers are doing to get the offers in. And this is looking at only the sellers that take the largest 10%. And that's because a large number of those sellers, as I've said before, don't do any price reductions. So by adding in a whole bunch of zeros really just makes the number harder to follow. You can see you're down here somewhere around 87.5%. So that means the sellers that are taking the biggest 10% discount are taking a 12.5% discount off their original ask price. And that's more than normal up here on the gray line. It's still less than the least you'd expect. So we've had 8 years of greater price reductions, and one that was fairly significant, it was 2023, where we had the huge cliff that we fell off of. Here's the ask price. So you can see that sellers are taking about 15% more price reductions than compared to typical. Here's the average, just because it's more easy for most people to understand. So you can see that we've gone from that 12.5% number to a number that just essentially 1%. And that's why I'm saying this is sort of hard to follow. You can just blow out your scale. But again, it tells you the same story. You're taking larger price reductions than you typically do. Here are the larger price reductions. You can see there really hasn't been much change for the past calendar year. Yes, the end of the year, the spring run-up was a little different. Here's the frequency of price reductions. So the frequency is exactly where you'd expect it to do. So to get the average to be higher, you know that sellers that are taking those price reductions at 12.5%, that's bigger than they normally take. So maybe they only take a 10% price reduction normally. And here's the frequency pulled out. You can see that we're taking a little bit more frequent price reductions, but still pretty close in what I call a normal amount of price reductions. Here's the average overbidding. So now this is what the buyers are doing. They're overbidding more. So even though the market's a little cooler, buyers are still overbidding more than they typically overbid. You know, and it's not dramatically, you know, it might be somewhere around here at 2.5%. And the overbid right now is at 3.25%. And this is for all of Silicon Valley. This is compared to normal, so you can see that you're a little bit more overbidding going on than typical. This is the frequency of overbidding. So the frequency of overbidding is almost right on normal. It's slightly above, but that would also tend to say that the buyers that are overbidding a little bit more than they normally do for this time of the year. This is the frequency. You can see you're pretty close to 100%. Again, what I call a normal marketplace, but a little bit on the hot side. Here's your long-term appreciation, as somewhat notated by the blue sloped line. You can see these V's at the end of every year. You also tend to have a run-up V, an upside-down V, and that's typically the first quarter of every year. So we're following the normal pattern. Our downward trend here may have happened a little bit early. It looks like we're having a fall plateau instead of a summer plateau. Here's your estimated payments. This assumes an 80% loan. You can see with the drop in interest rates, payments are coming down, but this is the cheapest 10%, just over $6,000 a month. The median is just over $11,000. Here's the active inventory. What we're doing now is we're comparing the three counties: Santa Clara County in the blue, Alameda County in the gray, and San Mateo County in the orange. The thing I would note is Santa Clara County has a lack of inventory now compared to Alameda County, and probably has the least inventory of the three counties when you come back and look at things historically. Here's offers accepted. And even though Santa Clara County had the least offers compared to Alameda, it's got slightly more offers. I'd actually call the offers the same level. So the Santa Clara County market is going to be hotter, and we'll see that right here. Santa Clara County is the hottest marketplace with a days unsold inventory of about 38, followed by San Mateo with a days unsold inventory of about 46. And the slowest marketplace, which is going to be real interesting coming up, is Alameda County at 56, and that's going to be real interesting. And it's the slowest days on marketplace for 3 out of 4 sellers to sell at 31 days. San Mateo County is second at 27 days. The fastest county is 22. And the reason I said that was interesting is you come down here, Santa Clara County is taking price reductions more than Alameda County is, even though Alameda County is a slower county. And frequency, Alameda County is doing the most price reductions. So Alameda County has to be doing a lot of small price reductions. And then here's where it really is interesting, is the buyer overbidding is at 6.5%. And that's the biggest overbidding. So even though it's the slowest marketplace, longest marketing time, the buyers are feeling the most pressure and going in at the highest. In Santa Clara County, it's at 105%. So not much of a difference, but 1.5% when you're only talking about 5% is fairly significant. Here's the frequency of overbidding, and it's even more frequent overbidding in Alameda County than in Santa Clara. And San Mateo, that is slower than Santa Clara, has more overbidding than Santa Clara County. So Santa Clara, that's the fastest, has the least frequent and the least amount of overbidding. Here's the long-term appreciation. Santa Clara County comes on top with the most appreciation, followed by Alameda County, and San Mateo County has the least appreciation, but it's improved dramatically based on their price increase this last week. Here's the prices. You can see how much San Mateo County went up last week. So now all three counties are roughly the same level they were in 2023, and they're getting to be roughly the same as they were back in 2021. I would still say that Santa Clara County is above, Alameda County is below, and San Mateo County is right at. Here's the same information on regular paper for those that prefer. Here's the estimated payments in the same order because it goes through the same formula. You can see that we are having the third slowest year out of the last 25 years. We're having the second slowest year out of the last 10. It's 2007. It's the slowest year for those that are interested. Here's the actual raw numbers for either Silicon Valley, Santa Clara County, San Mateo, or Alameda County, whatever you want, whatever metric. And again, look at the large number of inventory increase compared to just last week. Again, that's 2 weeks in a row with large increases. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Happy to meet with any consumers to discuss their real estate needs. We've been talking about Silicon Valley real estate market analytics for September 14th, 2024. I will be going on and talking about the Greater Bay Area, which is 5 regions, 13 counties in Northern California. Would appreciate a like on every video and a subscription once. If you want to look at a past episode, hit the blue URL here is my YouTube channel. If you want less typing, the green root URL gets you there as well. If you type in the green root URL plus 2024 Saturday morning at 9 o'clock, you can get and see the presentation live. The passcode is here if you need it. If you want a PowerPoint handout of the slides we've gone over, the green root URL, H for handout 2024-09-14, or any other date that you want to get the handout for. And any past episode is the green URL without the H, 2024, the month and the date. With that, I'm not seeing any questions. I don't see any unmuted mics. So I will move on into the Northern Bay Area. This is the 5 regions. Silicon Valley is what we've been talking about already. We're going to add in San Francisco and Marin, which I often call the cities. North Bay, which is Sonoma, Napa, Solano, and Contra Costa County. Central Valley is San Joaquin and Sacramento. Central is Santa Cruz and Monterey. Here's the inventory. You can see the areas that are lacking the inventory the most is the North Bay and Central Valley, because there's some number up here close to 5,000. You know, in recent years before the pandemic, maybe it was only 4,500, but now the number is only 3,000. So they're missing about a third of their inventory. Silicon Valley is missing a little bit, but you know, the number there might have been something closer to about 3,300, and now the number's something like 2,600. So it's only missing about 700, but you know, still a lack of inventory. Central Coast is almost normal, and San Mateo County is probably the closest to normal, but all 5 regions are at least slightly below their historical norms. Looking at offers accepted, the offers accepted, Silicon Valley is probably doing the best because all 3 counties or regions are fairly close together before the pandemic. And right now, Silicon Valley is clearly above Central Valley and North Bay, although both North Bay and Central Valley have been climbing recently, while Silicon Valley has either been coming down and then in recent weeks been flat, clearly catching up to the point where they're all going to be fairly close together again. The cities and the Central Coast are basically at their normal levels as far as looking at the graph and saying, yes, in 2020 and 2021, there was higher volume. But if you look before the pandemic and starting in 2022, the levels they're receiving is fairly normal. Days unsold inventory is the speed, the turnover rate of the marketplace, the supply-demand ratio, and Silicon Valley has got the tightest supply-demand ratio. Then you have 3 of the 5 regions very close together at 60 days of unsold inventory. That would be the Central Valley, the North Valley, and the highest of the 3 is the cities. And the slowest is the Central Coast at over 80. It's about 83 days. Now, marketing time, this is an easier concept to do. This is simply the length of time it takes 3/4 of the sellers to sell their property. Silicon Valley is the fastest area at just around 26 days. Then you have the Central Valley at 36 days, the cities at 40 days, and tied for last place is in the North Bay and the Central Coast at something like 46 days. So a lot of sixes in there. Clearly not a slow marketplace by any stretch of the imagination. If 3/4 of the sellers are able to sell in a month and a half, basically, that's pretty good. Now we're looking at price reductions. Price reductions are a measure of the seller's expectations due to market reality. The more price reductions is typically happening in a time when the market's slowing, so the expectations tend to be in the rearview mirror. So they come in the market, they think it's hotter than it is, and they have to do more price reductions. So you can see all 5 regions are on an increasing reduction, because 100% would be up here, 1% price reduction at Silicon Valley's here, 2% price reductions here, which gives you Central Valley at 1.5%, cities in North Bay at right at 2%, and then at almost a 3% seller price reduction is the Central Coast. Now, 3% price reduction may not sound like a lot, but remember that the agents and the sellers do their homework before they put their house on the market. So 90% of the sellers typically are not making any adjustment at all. So this is 10% of the sellers making almost a 30%. And when it gets to be that high of a discount, we'll probably find out that it's 20% of the sellers taking a 15% price reduction. And here is the frequency, and it's actually even higher than I thought. Central Coast, as well as Central Valley and the North Bay, are at 30%. So you take whatever percent reduction and divide it by 3. So that previous slide was basically a 3% reduction. It's basically a 10% reduction. So it's the 30% of your sellers are taking a 10% reduction to get to that 3%. In the Silicon Valley, somewhere only around 16, 17% of the sellers are doing a price reduction. In the cities, it was a little bit higher at about 19.5%. Now we're looking at the magnitude of overbidding. So this is what the buyers are doing to secure the property. And the most overbidding is in the cities at somewhere around 7% over ask price. Silicon Valley is close behind at 5.5% over the seller's ask price. Then you have the North Bay at something like 1% over. The Central Valley is right at the asking price, right at 100%. And Central Coast is about 1/4% below the seller's asking price. Frequency, this is how common, so you can get an idea of how widespread overbidding is. In Silicon Valley, it's right at 2/3, basically, or, if I was to look at this more accurate, it's probably 65%. So just a tad below 2/3 of the sellers are getting more than they're asking. Cities is 58% of the sellers getting more than their asking price. Then you drop below 50% with North Bay getting 46%, Central Valley at 42%, and the Central Coast at only 34%. So just a tad over 1/3 of the sellers getting more than their asking price. And you can see how aggressive it got, because Silicon Valley got up to here where 90% of the sellers were getting more than their asking price just before the market did that huge price correction in 2022. Here's long-term appreciation, and the most noteworthy thing that I point out every week is the cities. San Francisco and Marin has the lowest appreciation since 2015, below 30%. It's about 27% appreciation. And then the area with the most appreciation right now is the Central Valley at 90% appreciation. So almost a doubling of your money. Silicon Valley did double their money here at 100% or appreciation, and it's now down at 80% appreciation along with the Central Coast. And in second to last place is North Bay at something like 65%, 64% appreciation. Sold prices for the different regions. The most affordable region is the Central Valley at just over $500,000, 500,000, about 550,000. Then North Bay at just under 800,000. And then Central Coast at $1.2 million. That's 1,200,000. Cities is now significantly below the Silicon Valley. The cities is something like 1.5, and Silicon Valley is not quite, but almost 1.6 million. So there's almost $100,000 difference, with Silicon Valley being most expensive. And this is the first time there's been a reversal like this, except for this period of time in 2023 when we were going through that steep price decline. Here's the monthly payments. This is assuming an 80% loan, 30-year fixed, using the national interest rate published by the Federal Reserve Bank, which this week dropped to 6.2%. And again, the order is going to be the same. Silicon Valley is the most expensive, the cities, Central Coast, North Bay, and the Central Valley. Here are the actual numbers. You can look at whatever metric across the top, and then down the side on the left is the different counties. I do have Silicon Valley. The other region I put in is the Bay Area. That's the 9 counties above this point that touch the Bay. I do that not that I believe the number has any merit to analyze in the marketplace, but simply because the media talks about it so much of the time. And that wraps it up for Silicon Valley real estate market. I'm not seeing any unmuted mics, so thanks for joining. Reach out if you have any questions or any real estate needs. Thanks. Bye for now. Have a great week.